All right, everybody, so let's just go over the opportunities that were available today. All right. So here was the accumulation block right here. This occurred when the market retested the prior low. This was the low. This was in a spring position right here. And immediately you notice, increases in volume up, down, up. This is activity. So someone's buying. Why? Because this is the climax right here, where you see the 11. That's climactic volume at the bottom of a bar. So it's like a minor climax. And they bring it back up, and then there's more activity. And this is 2.5 times the average volume. This is 2 times the average volume, but it's not breaking through. And instead, when it goes into a spring position, what do you get? You get this change of behavior. So once you get that change of behavior, you have to ask yourself, what's going on? And what's going on is they're buying support. Simple as that. They're just buying support. And when they buy support, the market then pulls back, and this is what was a little confusing right here. The selling pressure came in, so it was obvious that the market would try to break, but they didn't let it break. All right. So from this level, there was buying, some more and more buying, and then the heavy selling wave, which went into this spring position. But it's difficult to identify if this is bullish or bearish, simply because it looks more bearish because of the heavy selling. This heavy selling was bigger than the buying, but it turned out that it was bought, and the only indication I could see was the breakout above it here on the biggest bar in 100 bars and 56 green bars, and that took the market up higher. It tried to again go down, but it was bought here, and just kept going. So what is the point here? The first thing is the levels. You must have insight about them ahead of time. The precondition to trading. Again, a precondition to trading is having your levels marked. A precondition to trading is understanding the context of the market. And what the context of the market is nothing more than A, trend, B, levels. That's it. And on the higher time frame. That's context. All right, so in that level, if it goes back to support, you want to see if there's buying or they're going to break through. There's only two options. Are they going to buy support or are they going to break through? And if it's a slight break, is there follow through or isn't there follow through? If it isn't follow through, chances are it's going to go back in the range. So it goes to support. That's what you need to know ahead of trading the ES or any market. And then when it's at support, it's at the location of where to find trades. Where to find trades is support and resistance. And you're looking to see if there's a trade here. And the trade came to the upside. How do you know it came to the upside? Well, because of the buying activity here and on the wave chart exposing the buying right there. This was the biggest buying wave in 11 waves. 11 waves. Why would the biggest buying wave at an attempted breakdown be on the up wave instead of the down wave? Right? So this is the breakout, but in reverse. Meaning, as you go to support, your expectation is for it to break through on heavy volume. But instead, it breaks back in the range on heavy volume. And that's the key indicator. So there you go. There's the biggest in 11 waves in terms of buying activity. And the damn thing just goes up. This was difficult to trade. So, if you didn't, because it didn't pull back immediately, went up, 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 and then went down here. So it fools a lot of traders right here that it's selling. But selling is basically coming back to support. And when it came here, it had a chance of breaking, but it didn't. Instead, it went up. After that, there was another opportunity to get in on the pullback. But When it rallied into this resistance area, it pulled back here, one test, and was ready to go, but they wanted to get rid of everybody before the move. So what are they going to do? Answer is a spring. Right, this low gets sprung. Now, how did you know that this was a spring? Look at the measurement of the bar. I don't know if it's visible here that clearly, but the way it came back, typically you want the spring bar to be strong. And sometimes here, like for example, here you can't see it, but the wave is strong. This wave has 50% more volume than average. So 1.5 times the volume came in here, which is bigger than these three waves. And definitely the wave that tried to break down got taken out right here. And after that, it continued higher. All right, so the campaign again starts with knowing your levels, going to your levels, buying activity at your levels. Basically, what I'm saying, buying activity is accumulation. And then the markup of prices. Again, levels, accumulation at the levels, and the markup of price after that. So that's what the setup is. And same with distribution, the same shit. So I'll show you one more example that occurred today. So this is on crude. Here again, it went down, up, down. So it's taking out this rally low, right? But is it going to fall through, or are they going to break it back in? So again, we know the level. It's nothing more than support and resistance, folks. Support, resistance, either important price areas or important volume areas. That's all it is. There's no intelligence. You know, if you can see the pivot, you can identify support and resistance. If you can see high volume, you can identify high volume. And both of them, price and volume, are your support and resistance. Why? So I don't want to get into the why, but I'll get, you know, I know just one thing leads to another and I keep on talking. So the point here is that here it's at support. What happens at support? Yeah? The hell was it? Was it here? Oh yeah, right here. Right here. Now I couldn't identify the brick, the box with heavy volume. So I have to see the box volume and bar volume. So the bar volume is what gave it away. It wasn't the PNF box having heavy volume, meaning the volume and price, but the column, the PNF column volume, it increased too much. And it did not have any reward, meaning a lot of effort, no reward. Right here, 2.5 times, but it's not going down, right? So it's 2.5 times, but where's the big red bar? Instead, what you had at that level, you had accumulation here and price running away from that accumulation, getting ready to mark up right here. Right there with the change of behavior, yeah, and the higher high confirmation. Now the only thing you have to do is be careful and don't just buy dumb. You know, it had to come down. It sniped the low right here and then went up to this level. Okay, so again, how was this intraday campaign conducted? Basically goes to a level. From that level, there is either accumulation or a breakdown. The only thing at the support levels, you're looking for one of two things. Again, at support level, you're looking at one of two things. What are they? A breakdown, or B, accumulation. At resistance, you're looking for one of two things. A breakout, or B, distribution. Okay, so you have to have the level marked, and these guys, whoever's doing this, they're not, you know, they plan. So when they plan, what do you think the first thing they do is they have to identify level. So what do you think they're going to do? They're going to look at where the market turned before. That's why these levels were working, because that's where it did the same buying or selling activity before. So they're using that as a reference point. It's just logical and common sense for you to buy at good prices or places where it did the same thing that you wanted to do now before. So here is where there was a turn, and that same level you want to look for accumulation or a breakdown. What do you get? You get accumulation. Where is it? Right here. 2.5 times the average volume. As this occurred, am I sure there's accumulation? Obviously not. But if price runs away from this, in this case, a change of behavior or sign of strength or whatever, koch, right? Which is just buying, then I know it's accumulation. Because they're not going to let it fall. They want to buy the level. So let them buy the level, take it higher, and you got to get in on the pullback. And don't just recklessly get in on the pullback, because you'll get stopped out if they do a spring. You have to let it reverse. Let it reverse, go long, and boom, goes up. All right, so these are the two campaigns today. One is on the ES, which I clearly showed, and the other here is on the crude market. The ES was a bitch because of the spring that it had later on, was intended to take out all the shorts. All the longs prior to that massive move. And the second reason why it was difficult was because it didn't pull back after the change of behavior right away. It went higher and higher and higher, and then it had a selling wave, which confused a lot of folks, including me, to be on the fence. Is this buying or is this selling? Is this going to go in an uptrend or is it going to go a downtrend? We don't know. We don't know, so nobody knows. And you have to, basically that's what risk is. Be comfortable taking the risk to find out, to see if it works or not. And if it doesn't, you either cut it or have very small attempt at whether it works or not. And sometimes it will just spring and then give you a re-entry. And other times you won't get it. You just have to wait for the next one. All right, so again, you have a level, which is your reference point of a potential area. What is a level? Right? I think maybe that's what I need to discuss. A level here, there are two types that you need to know. One is price, the other is volume. Price levels are where the market demand was greater than supply or supply was greater than demand. A pivot is when demand overtakes supply. So basically demands grow more than supply. A down pivot like here is where supply is greater than demand. So these are your reference points for trades. All right, that's the first thing you need to know. And from a volume perspective, it's just a lot of volume. Now, why are these levels so important? Why are they used? The answer is liquidity. All right, if you're going to create a position, you need to accumulate a lot of orders. Where are the orders? Answer, above highs and below lows. That's where the orders are. That's where the liquidity is, above highs and below lows. And you need that in order to establish a position, because your position requires the accumulation or distribution of a lot of volume. So that's where the volume is. Second, from a volume perspective, it will be at your high volume levels. So you need to take price into the areas of high volume in order to, because there was a lot of volume in the past, chances are there's still a great reference point for there to be a lot of volume there in the future. So you got to take price to that area and build the volume. So campaigns require volume. I don't really like using the word liquidity and all that, but there is a distinction. Liquidity is volume that is not executed. Volume is liquidity that is executed. So we'll just use the term volume to make it simple. So where's the volume above highs, below lows? You need the volume to build a position and to accumulate / distribute. So you have to take prices to these levels and build the campaign or the position, the accumulation or distribution. And that's why you have to have these levels marked on your chart, and then diagnose and see if that's what's going on. So in terms of price levels, highs and lows, it's either going to break out or there'll be accumulation or distribution there. And in terms of how does it look, you have to use whatever tools you have. Whatever tools you have to use. If you want to use market profile, if you want to use volume profile, if you want to use just bar action, right? If you want to, whatever tools, you need to be able to identify what's going on at those levels in terms of what the hell is the smart money doing. Okay, folks, hope you have understood the lesson. And this is different in what other people are doing, because this actually, what most folks will do is they'll have a wave chart, or they don't even know how to use a wave chart, and they'll have just a bar chart. And they'll just look at bar volume. But we know that there's a problem with bar volume intraday. It's useless, almost useless. Because volume, when it's broken up into 5-minute intervals, you cannot see the force of the buying and selling. It has a U shape from the beginning of the session to the end of the session. It's really, so it cannot be used. It can be used on daily, but it cannot be used on intraday 5-minute chart. It just, right? So that's why Wyckoff and also other Wyckoff practitioners use the wave chart. What I've done is using the wave chart along with the tape reading chart or the point figure volume chart in the way Wyckoff used it. The only difference is I have more indicators, and also I modified it to be like a higher time frame, so it's not like tick by tick, because you cannot do that in today's market like it was done in 1920. It has to be adjusted for today's volatility. So it's just this. All you gotta do is just adjust for today's volatility, and then just look for high volume and movement, like change of behavior, sign of strength, because accumulation will be the accumulation of volume, right? So that's about it. And also you can also use Renko. Renko, as you can see, look right here, bang, right here, the volume came in. They accumulated on a lower time frame. This is a significant move. This is an entire day trade. See, so the volume came in, it went up right here again, 1.6 came in again. You know, the bounces are coming in. At those levels, buying activity goes down, buying activity test goes up. So we might have a turn here to go even higher. So, you know, so however you do it is just looking at buying support levels, resistance levels as your points of reference, and detecting whether accumulation is occurring at those levels, whether distribution is occurring at resistance or accumulation is occurring at support. And then the skill is interpreting it and being able to recognize it, right? So this is what needs to be taught to Wyckoff traders, because this is what Wyckoff taught. If you go to his original course, there are 5 studies done just by him on this type of chart, this tape reading chart, where you see all the numbers. There are 5 studies by him in his course, which you can go on Google and just get it free. So this is what should be taught. The other things that you guys are taught about climax, automatic rally, secondary test, that is important, but the way it's taught as a pattern and in hindsight is not going to help you trade. You cannot trade off of like hindsight labeling. And also phase A, B, C, D, that also, I don't see how that's helpful at all. You have to be able to diagnose. Why? Because you need levels. It's not just climax, automatic, rally, secondary. You need levels. And you need to know how to judge behavior occurring at those levels. And that's what needs to be taught. All right. Take care. Have a good day. Bye bye.